Good evening, everyone.
Good evening, sir. Good evening, sir.
Good evening, sir.
Good evening, sir.
Good evening, sir.
Good evening, sir.
Good to see you guys. How is exam preparation?
Good, sir.
Full tension, right? Okay. We'll not waste a lot of time. What we will do is today, we are breaking the session into two parts actually, because looking at the way GST paper and the tax paper is, set, okay, uh, looks very complex because finer points are being asked, though it is working knowledge which is required to be tested, but a lot of finer points are being asked. So what we will do is today we are going to revise the entire syllabus, okay, and tomorrow's session we will try to work on some revision test papers, okay, or suggested answers, so that we get some practical way of how the question paper will look and how we are expected to solve those questions as well. Okay, so today 1.5 to 2 hours we will restrict ourselves to only the theory part, and then subsequently we will go to the problems part. Okay. So I've got one small booklet which was shared. I am sorry if I shared it pretty late, but I wanted to consolidate everything so that every topic is there in one page. It becomes easy for you to revise at the time of exam. Okay, so that is how I have prepared that revision test paper. Hope that is useful to you. Right, so let's go to concepts of GST. We'll go chapter by chapter, so don't worry, everything we will cover as per the institute modules which you are expected to follow. We will go chapter by chapter. Okay, chapter 1 is introduction to GST. So GST was introduced into India on 1st July 2000, introduced in India on 1st July 2017, correct? Don't forget that date. It was in between the year after 3 months, so it was introduced on 1st July 2017. Now, for the purpose of introduction of GST, the constitution had to be amended. Okay, why constitution had to be amended is because some of the powers were with the state, some of the powers were with the center. So center could levy tax on manufacture of goods, but state could levy tax on sale of goods. Okay, these powers had to be brought in together, consolidated, and center had to give up their powers of levying excise duty on manufacture, and state had to give up their powers of levying tax on sale of goods. So both had to come together, give up their powers, okay, which were given by the constitution. So constitution had to be amended to enable the state and the center to give up the power and assume new powers. Okay, so a new section was introduced, which is article. In constitution we do not have sections, we have articles. Okay, article 246A. Okay, there was 246, there was 247, that to amend, so they had to bring it in. That is why it was 246A. So article 246A allowed the center and the state to empower them to levy taxes on intrastate sale of goods and services. So center also could frame the laws, that is why they framed CGST Act, and state also could frame the laws, that's why we had Karnataka GST Act, Tamil Nadu GST Act, West Bengal GST Act. Okay, then there was another section which was introduced, 269A. So there was 246A to give them powers to levy taxes on intrastate transactions. Then there was article 269A to enable the center to levy taxes on interstate transactions, that is between two states, and that is when IGST came into picture. Is this clear? But why was GST introduced? The reason why GST was introduced is because before GST there were multiple taxes. There was cascading effect of taxes, that means there was tax on tax. Okay, Indian products were not competitive in the global market because we were not just exporting the goods, we were exporting even the taxes. Our prices also had taxes. Okay, and fourth, whenever I pay the taxes, I was not getting back anything, and I am used to cashback because of so many startups. I want cashback everywhere. Okay, plus because there were so many taxes, the ease of doing business in India was nothing. Because today central excise officer will come, tomorrow excise officer, sorry, service tax officer will come, day after tomorrow sales tax officer will come. So there was no ease of doing business. All these factors, apart from the fact that the tax laws itself were so complex that nobody knew when will excise duty apply, whether the transaction I am dealing in is goods or services. Okay, to address all these situations, they thought, let's remove the old laws which are as old as 1956, 1944, 1962. Okay, as old as it can be. Okay, they removed all those laws on 1st July 2017 and said we will introduce a new tax. This new tax will allow seamless flow of credit, and it will be a destination based consumption tax. Now, what is the meaning of these two things? Seamless flow of credit means whatever you pay to the government for purchase, you will get input tax credit of that when you sell or when you provide output services. You don't have to sell the same product. Like, I'm a chartered accountant, I am buying a laptop, I don't have to sell the laptop, I am rendering my services, okay, by using this laptop. So I will get input tax credit or the cashback of the GST paid on this laptop, and I will be able to set it off against the output tax payable to the government when I'm rendering services. Okay, so I get an input and I get output. How does it operate? Exactly like Paytm cashback. I purchase an iPhone of 1,50,000 rupees. I get a cashback of 50,000 rupees. I can utilize that 50,000 cashback only when I make further purchases. If I don't make further purchases, that 50,000 I cannot use. Likewise, if I am using this asset which I have purchased or raw material which I have purchased for generating output tax on which I am required to pay the taxes, I will be able to utilize this input tax credit. Otherwise, I am not entitled to claim the input tax credit. Is this clear? Right? So seamless flow of credit means as long as a transaction is related to your business, you will get the input credit or the cashback of that tax which you have paid on the purchase. And seamless means earlier what would happen? I am shopper stop. My input is rental. I have an office close to Forum, Kormangla. I have paid huge amount of rent, okay, on which I am paying huge amount of service tax. My input is service tax, output was VAT. Okay, I was not entitled to claim the credit because I am purchasing on Flipkart, but money is in Amazon wallet. Correct? Now, with the introduction of GST, what happens is my input is CGST, SGST, my output is CGST and SGST. The distinction between this is a central tax, this is a state tax, all goes because on my entire transaction, there is central tax also, there is state tax also. Clear? So I am entitled to claim credit on anything and everything. That is why it is called seamless flow of credit. Okay. Next, it is a destination based consumption tax. Now, what do you mean by destination based consumption tax? Earlier, the tax would go to the state from where the goods originate. Meaning, if I am talking about your screens are frozen. Am I audible? Is my internet okay?
Yes, sir.
Okay, right. Okay. So earlier, what would happen is if I manufacture the goods in Karnataka and sell the same goods in Karnataka, okay, or outside Karnataka, the revenue would go to the central government, okay, the excise duty. But state tax laws, meaning local sale would go to Karnataka, okay, and interstate sale would also go to Karnataka. That means Karnataka would get the revenue as long as goods are manufactured in Karnataka. So Karnataka would get money, Maharashtra would get money, Gujarat would get money, but all these goods are getting consumed in UP, Bihar, Jharkhand, and all the other populous states. They were not getting money. In GST, they changed the entire concept itself. They said, now we don't want to give money to the origin states. Now we want to pay money to the destination states. So now it became a destination-based consumption tax. So the two fundamental points of GST is one, seamless flow of credit, and two, destination-based consumption tax. Is this clear? Okay. Now, how will the GST law work? For GST law to work, they have to keep making amendments to the law. Okay, if there is any problem, they have to keep making amendments to the law. Earlier, the central law would be amended by Lok Sabha, Rajya Sabha. The state law would be amended by Vidhan Sabha. Correct? But now that CGST and SGST will have to go together, they cannot sit and work together. So what they did, they started something called as a GST Council. Now GST Council will tell what Lok Sabha has to do. GST Council will say what Vidhan Sabha have to do. So all the finance ministers have to sit together and decide whether some amendment has to take place or not. Okay. Center has 1/3 voting powers, meaning 33% voting power, and all the other states put together has 67% voting power. And for any resolution to pass in the GST Council, 75% approval is required. That means center is compulsorily required, plus some states are required. Only then the GST law can be amended. Otherwise, the GST law cannot be amended. Till here it is clear? Okay. Now, how was the revenue shared between CGST, SGST, and IGST? Very simple. CGST charged to the customer will go to center. SGST charged to the customer will go to the state. IGST does not belong to anyone. IGST does not belong to anyone. But when IGST is set off against CGST, that much money goes to the center. When IGST is set off against SGST, that goes to the state. Now, how does the set off mechanism work? Always, I have to ensure that my IGST balance becomes zero. IGST has to be first utilized against my IGST liability, and the balance IGST credit can be utilized against CGST or SGST, whichever way I want to. Preferably 50% CGST, 50% SGST. That is the best mechanism. Okay. Once I have exhausted IGST, now I move to CGST. CGST 50% will go to, sorry, CGST has to be utilized against CGST liability. Balance left over has to be adjusted against IGST. SGST first utilized against SGST. Balance left over has to go to IGST. CGST cannot be set off against SGST. SGST cannot be set off against CGST. Clear? That is how the mechanism will work. You have to be very careful because a lot of problems are being asked where you have to be very careful about this set off mechanism. Ensure that IGST becomes zero. Only then you can tax CGST and SGST. Otherwise, you cannot tax CGST and SGST. Clear, everyone? Okay. Now from here, we move on to definitions. Okay. We go to only important definitions. What is India? Okay. India is all the states put together, all the union territories put together, the air above, the water below, and 200 nautical miles from the baseline. All of this put together is India. I will repeat again. All the states, all the union territories, the air above, the water below, and from the baseline, Goa, from Goa 200 nautical miles, from Andaman and Nicobar 200 nautical miles, from Kanyakumari 200 nautical miles. All of it is India. So any transaction you do in India or up to 200 nautical miles of India, it will be subjected to GST. Is this clear, everyone? Right? Okay. Now goods. What is the definition of goods? Anything which is movable is goods. Anything which is movable is goods, but does not include money. So money is not goods. It does not include securities. So all these Reliance shares is not goods, but includes actionable claims. Okay. So actionable claims are goods. If you go to Schedule 3, Schedule 3 says, I am not required to pay taxes on certain transactions. Schedule 3 says on actionable claims, you are not required to pay any transaction, any tax, except betting, gambling, and lottery. That means all actionable claims are goods, but only betting, gambling, and lottery are, which are goods being actionable claims, are liable to GST. All the other actionable claims are goods, but because of Schedule 3 are not liable to GST. You're able to follow, right? Okay. Now we go to definition of services. So goods is defined under section 2, subsection 52. Section 2(1)(02) defines the term services. Services means anything other than goods. So whatever is not goods will be treated as services. Okay. Now, apart from this, money is not services. So you are not required to pay taxes on money. Security is not services. So on that also you are not required to pay taxes. Okay. But any transaction in money any transaction in securities where a consideration is charged. Okay, like loan is given by the bank for which processing charges are charged, that will be liable to GST. Okay, if I enter into a transaction for securities where commission is charged by my broker, okay, that will be liable to GST. Okay, but any other the transaction per se of money, the transaction per se of securities, that will not be liable to GST. Is this clear to everyone? Right? Okay. Now with this, we move to Schedule 3. Schedule 3 talks about those activities which will not be treated as supply of goods, which will not be treated as supply of services. Okay.
Sir, you were not audible.
Hello. Is my voice clear?
No, sir, you were not audible.
Okay, now is it better?
Yes, sir.
Okay, right. Because even I am able to see that your videos are frozen. So, right. Now it's better, right?
Yes, sir.
Okay. So now we go to Schedule 3. Schedule 3 says what are the transactions which will neither be treated as supply of goods nor will be treated as supply of services. That means on these transactions, there will never be tax. Okay, I'm not required to pay tax on the same. What are those transactions? Those transactions are: one, employee to employer in the course of employment. So whatever an employee does to the employer in the course of his employment will not be liable to GST. But one thing which we have to keep in mind is employee and employer are treated as related parties. And because they are treated as related parties, anything which is outside the employment contract will be treated as a deemed supply and liable to tax. Example, if employer gifts employee something worth 1 lakh rupees, that will be liable to GST. Okay, but employer gifts something to employee worth 20,000 rupees, it is taxable, but because there is a limit of up to 50,000 rupees gift which the employer can give, it will not be treated as liable to GST. Clear, everyone? At least some nodding. You should show thumbs up.
Sir, your video is lagging.
Sorry.
There is a video lag, sir.
From my side?
Yes, sir.
Okay, let me change again the internet settings. 1 second. I'll just change my internet settings then.
Yes.
Give me a second. Yeah, now is it better?
Yes, sir.
Okay, right. So now we were talking about, no, again, there is a lag. 1 second. I'll just check what is wrong. Give me a second. I'm sorry. I'm wasting a very precious time. I'm 1 second. There's some issue with the internet. Okay, now is it better?
Yes, sir.
Okay,
Yes,
right.
sir.
Thank you. So we were talking about Schedule 3. When employee provides
Sir,
any
there
service,
is a lag again, sir.
again now, I don't know. Shall I just switch off my video? Is that okay?
Yes, sir. Yes, sir.
That will not be effective actually. 1 second. I'll just last My neighbor generally pays the internet bill on time. At least last we'll try his. My internet is not working. So okay, now is it better? Now there is a lag. No.
Yes.
Audio is clear.
Audio is clear. Video has a lag.
Oh, okay. I'm sorry. I'm sorry. I don't know why, but this is the fastest internet I have. I'm at office actually, not even at home. Okay, let's see whatever best I can do. So Schedule 3 says employee to employer not in the course of employment not liable to tax. That means anything which is not in the course of employment or whatever employer gives free of cost to the employee except to the extent of 50,000 rupees will be liable to tax. Clear? Second, we have already discussed actionable claims other than betting, gambling, and lottery will not be liable to tax. That means actionable claims in the form of betting, gambling, lottery only will be liable to tax. Clear? Third, sale of land and completed building is not liable to GST. Sale of land and completed building. Under construction building will be liable to tax. It will be treated as a service. Is this clear?
Yes, sir.
Fourth,
Yes, sir.
or any tribunal fees, what we pay, not liable to GST. Right? Okay. Fifth, funeral charges, crematorium charges, etc., not liable to GST because GST is a destination based consumption tax. Here destination is not India. Correct? No? Right? Okay. So because of that, it is not liable to GST. Don't write all this in examination. Okay. Next, very interesting from a customs angle. Okay. Very, very interesting from a customs angle. In customs, we have something called as bill of entry for home consumption. Okay. When I have to pay customs duty, first I have to file bill of entry for home consumption. If I don't file bill of entry for home consumption, those are not Indian goods. Those are always treated as goods which are outside India. Okay. So any transaction executed before bill of entry for home consumption is filed is not liable to GST. Let's take an example. I'm in India. I have a vendor in Africa. I have a customer in Australia. Okay. I get the goods from Africa, send it to Australia without taking delivery in India. So pick up from outside India, delivery outside India, it does not even come into India. In this case, transaction is not liable to GST. Is this clear? Because India goods have not entered India at all. Okay. Second, say suppose goods are coming into India. From Africa, the goods are coming into India. But before taking the delivery of the goods, I transfer the document of title to some third person. Say I transfer it to Mr. Chandan. Okay. Then my sale to Chandan will not be liable to GST because those are not Indian goods at all. I have not filed bill of entry for home consumption. Is this clear? The second transaction is clear. I am getting it into India. But before filing a bill of entry for home consumption, I have transferred these goods to Mr. Chandan. Both of us are in India. Goods are outside India. Okay. It will not be liable to GST. Third, I will get the goods into India. I will not file bill of entry for home consumption. I will file bill of entry for warehousing. That means I will store it in a warehouse. It is not any warehouse. It is customs warehouse. It is called bonded warehouse. Okay. Not 7 James Bond warehouse. Okay. And from there, when I sell it to another bonded warehouse, it will be treated as if the goods are outside India. That bonded warehouse is treated as a territory outside India. Okay. Even in that case, when I sell the goods from my bonded warehouse to Chandan's bonded warehouse, that will not be liable to GST. Is this clear? Right. So 3 transactions. Transaction 1, goods never come into India. Transaction number 2, goods before it comes into India, I sell by way of transfer of title in goods. Third, goods come into India, but in a bonded warehouse. In all these 3 cases, I am not required to pay tax because Schedule 3 says this is not treated as supply of goods or supply of services. You're able to follow, right? Okay. Now we go to schedule 2. Schedule 2 says transactions which will either be classified as goods or will be classified as services. Okay. So role of schedule 2 is to only tell us whether the transaction is that of goods or the transaction is that of services. Okay. So now schedule 2 says if you are buying, that means there is a transfer of property in goods, then the transaction is transaction of goods. But when you are getting the goods without the ownership, that is a service. Like I buy a laptop, goods. I take a laptop on rent, service. Is this clear? So when I get a property, it is goods. When I get only the possession of the property without getting the ownership in that property, that will be treated as service. Okay. Restaurant is deemed to be service. Okay. Works contract, unless it is a completed building, is service. Temporary transfer of intellectual property, copyrights, etc., service. Permanent transfer, goods. Is this clear? Right. So wherever there is a permanent transfer, it will be goods. Otherwise, all of those will be treated as services. Clear?
Yes.
Right? Okay. Now we go to the definition of supply. Supply has 4 limbs. When we were discussing, there were only 3 limbs. Then they added one more limb, saying how can it be so simple for all the chartered accountant students? So amended one more line retrospectively. Okay. So there you have 7.1a, which we discussed in the class. Okay. What is 7.1a? There has to be a supply for consideration in the course of business. Only for transaction is a supply in the course of business for consideration, it will be liable to GST. If the transaction is not a supply, if the transaction is not for consideration, if the transaction is not in the course of business, then I'm not required to pay tax. Let's take few examples. Okay. I sold land. Is it liable to GST? No, because it is not supply. Supply means supply of goods and services. What I'm talking about is not supply of goods and services. Correct? So it is not liable to tax. Okay. I donated laptop free of cost. There is a supply, but there is no consideration.
No concept.
So no need to pay tax. Okay. I am an employee drawing salary. I have a car. I sold the car. There is a supply for consideration, but it is not my business to sell the car. So again, it is not liable to tax. So one-off transactions will not be liable to GST. Okay, so 7.1a says there have to be 3 conditions which are required to be satisfied for the purpose of GST. Supply for consideration in the course of business. If supply is not there, or consideration is not there, or business is not there, GST is not required to be discharged. Is this clear?
Yes.
Then we have 7.1AA. What is the 7.1AA? Okay, 7.1AA is, which was not there earlier, which was introduced recently, but it's applicable for your exam. 7.1AA is, or in income tax, you have something called as concept of mutuality. Okay, what is that? Members and association are same persons. They cannot earn profit out of each other. Correct? In GST, the issue was, when the association renders services to members, will it be liable to GST? Okay. Supreme Court said it is not liable to GST in service tax. Supreme Court said when association renders services to a member, it is not liable to GST because members and association are same. But this was rendered in the context of service tax. GST law amended the law retrospectively and said, notwithstanding whatever the court wants to say, let them say whatever they want to say, the transaction between the member and the association will be liable to GST. That is a supply. Is this clear? 7.1AA. Right? Then 7.1B. Supply for consideration, whether or not in the course of business. What is that? Import of services. So when I import the services, whether it is in the course of business or not, I am required to pay tax. Who is required to pay tax? The person who receives the services is required to pay tax under reverse charge mechanism. Clear? Okay. Then 7(1)(c), supply in the course of business, whether or not there is consideration. So even if there is no consideration, as long as there is a supply, you are required to pay tax. Clear? For that, we have to go to Schedule 1. We already covered Schedule 3. We already covered Schedule 2. Now we go to Schedule 1. What does Schedule 1 say? Permanent transfer or disposal of business asset on which ITC has been claimed. So if you have purchased a laptop and you have claimed input credit on that, that is cashback, you are giving it free to NGO. Now Paytm says you have purchased iPhone from me, taken cashback of 50,000. You cannot return the iPhone back. Correct? If you return the iPhone back, you have to give back the cashback also. Right? Can you say I will buy from iPhone, I will take the cashback and I will give the iPhone? Best business, no? Correct. Likewise, government says if you have claimed cashback from me, now you cannot donate it to somebody. Don't do charity with my money. Correct. If you give it to somebody, then you will have to reverse the input tax credit. How? By calculating 5% per quarter as depreciation. You will have to reverse the input tax credit. If you have used it for 2 years, that means 40% you have used. To the extent of 40% you can claim credit. That is 5% multiplied by 8. The balance 60% you will have to reverse. Clear, everyone? 5% per quarter. So 1 year it will be 20%. Right? Okay. So that is one. Second, transactions between related parties and distinct persons. So when you are transacting with a related party or with a distinct person, you are required to pay GST irrespective of whether there is consideration or not. So when you transfer the stock from branch A, your branch A, to branch B, which is outside the state, you are required to pay GST because you are related party or distinct person. When Reliance transfers the goods to Jio, assuming these are two companies, Reliance Industries to Reliance Infotainment System, okay, they are required to pay GST because they are related parties. And when the transaction is between related parties, consideration is not the criteria. Okay. Third, if you import services from a related party, then whether consideration is there or not, you are required to pay tax on the same. Clear? Fourth, when you transfer the goods to your agent and the agent raises the invoice in his name, then the transfer to that agent will be liable to GST. So four scenarios where even if there is no consideration, I am required to pay GST. Is this clear? So that is as far as section 7 is concerned, which defines what is supply. Now we go to section 8. What is section 8? Composite supply, mixed supply. So what is the difference between composite supply and mixed supply? Composite supply and mixed supplies are multiple supplies of goods and services. Both have more than one goods or services. Okay. But the point here is that in case of a composite supply, you have one principal supply and everything is incidental to that. Okay. But when it comes to a mixed supply, all the supplies are important or all the supplies are not important. There is not one predominant supply. Let's take an example. Okay. I buy masala dosa, same example. And they give me, okay, container so that I can pack that masala dosa and go home. Okay. Is it a composite supply or a mixed supply?
Composite supply.
Composite supply. Okay. Along with gold coin, I get pressure cooker free.
Mixed supply.
Mixed supply, because here there is nothing important the other, and there is no relation between the gold coin and pressure cooker except that both my wife will only use. Apart from that, there is no relation only, and both of it I will only pay. Right? Okay. Now, air ticket And along with air ticket, I got one sandwich free.
Mixed.
Mixed.
Oh.
Composite.
Mixed.
Composite supply.
It's a composite supply because one is main and other is incidental to that. Correct? Okay. Then caps classes with study material.
Composite supply.
Correct. The material has been given to facilitate the classes, but without the material also classes can go on. Clear? Okay. With one pair of shoes, another pair free. One pair, English pair I am talking about, not Hindi pair. Okay, so with one pair, another pair free. Composite or mixed? Anaga, even if it is mixed, the rate of tax will remain the same. Because the rate of tax is the highest rate for shoes will be same only. Correct? No. So the composite supply, the rate of tax applicable is the rate of tax applicable to the principal supply. But in mixed supply, the rate of tax applicable to the highest rate will be applicable. Now, assuming you go to more superstore and you buy hundreds of items, is it composite supply or mixed supply? You buy pressure cooker, you buy washing machine, you buy iron, you buy watch, you buy soap, you buy garments, you buy tissue paper, you buy toilet paper, everything you buy. Composite or mixed?
Mixed, sir. Mixed.
It is individual supply, no link only between products. Hey, Aarti madam, I thought you do shopping at home. Check every product will have different rate.
Yes, sir.
Correct? No. Pratiksha is like, my God, so many days teaching, everything gone for a toss. It's as if first class I am sitting. Same question, same answer. No change, only in answer. Very good. When are your exams? Wrong question.
November, sir.
November. This year only, no?
Yes, sir.
Okay. Very good. Nice. Good preparation. Right. Okay. So that is as far as section 8 composite and mixed supply is concerned. Now we go to section 9. What is section 9? Section 9 is charging section. Okay, that says whether tax is applicable or not, and if applicable, how. Section 9 subsection 1 says there shall be levied a tax on all supplies. What is supply? We discussed in 71A, 71A, 71B, 71C. There shall be levied a tax on all supplies. What kind of supplies? CGST says it will be on intrastate supplies. Anyways, intrastate and interstate is not applicable to you, but be mindful of the fact that CGST and SGST is applicable to intrastate and IGST is applicable to interstate. Okay, so section 9 says GST is applicable on all intrastate supplies, okay, of goods and services other than alcoholic liquor for human consumption. So on alcohol, there will be no GST. All the other goods and services, there will be GST on what? On value determined under section 15. Go to section 15. 15 will tell you the value. Okay. And the rate of tax cannot exceed 40%. 20% in CGST, 20% in SGST. It cannot be in exceeding 40%. And who will pay the tax? The taxable person. That means any person whose turnover exceeds 20 lakh rupees is a taxable person. Person liable to register is a taxable person. He will have to pay the tax. Okay. Section 9 subsection 2 says that forget whatever I have told you in 9.1 for petrol and petroleum products. Okay. GST will apply only when the GST Council decides the date on which petroleum products are to be included into GST. So basically, on alcohol, there will be no GST because 9.1 excludes it. On petroleum products, there will be no GST because Council has not decided the date on which GST is to be charged. Okay. Then we go to section 9 subsection 3, which talks about reverse charge mechanism. Section 9 subsection 3 and section 9 subsection 4, which talks about reverse charge mechanism. Now, what is this reverse charge mechanism? It means instead of the supplier of goods or provider of service, the recipient of goods or the recipient of services is required to pay tax under reverse charge mechanism. Because the entire mechanism is reverse, that is why it is called as reverse charge mechanism. Okay. Now instead of getting into too much of detail of RCM, because that is what you would have to do. Okay. Very simple. GTA, Goods Transport Agency. Okay. Rent a cab operator, security agency services, services rendered by the government, import of services. All these services are services rendered by the director to the company. All these services are liable to tax under reverse charge mechanism. We can have a separate session only on RCM, but you will have to read it. I'm just running through all the entry. Services of sponsorship to a body corporate, legal services by a lawyer to a business entity are all services which are liable to tax under reverse charge mechanism, and the recipient is required to pay the taxes of the same. Okay, so that you will have to read in detail, because the recipient part is very important. In case of legal services, it is business entity. Correct. In case of sponsorship, it is body corporate. In case of rent a cab, it is registered person. In case of government entities, services by government, it is business entity. In case of GTA, it is specified person. Specified person can be a company, it can be a partnership firm, it can be a cooperative society, it can be a factory under the Factories Act, it can be a person registered under the GST law, or it can be a casual taxable person. Correct? So any of these. In case of security, the services rendered to a body corporate. So you have to be careful as to who is the recipient. Only if the notified service is provided by a notified supplier to a notified recipient, RCM will come into picture. If all these three conditions are not satisfied, GST may not be applicable under reverse charge. It might apply under forward charge. Example, lawyer providing legal services to a business entity is liable to tax under reverse charge. Lawyer providing renting of involved property to body corporate, no RCM, because it is not a legal service. It is illegal. No, it is renting of involved property service. What is under reverse charge is only legal services. But what the lawyer is rendering in this case is renting of involved property services. That is not liable to tax under reverse charge mechanism. You are able to follow Sridevi, madam? No. Yes, no. Yes. Very good. Right. If you say yes, no means we don't know whether it is yes or no. Right. Okay. So now from section 9, subsection 3 and 4, where you will have to do a detailed study. Okay. Please do a detailed study of 9.3. We move to section 10. What is section 10? Composite supply. What is section 10?
Composition.
Composition, not composite. Composite is 8. Composition is 10. Clear? Composition scheme. GST is very difficult. That is why they introduced a new scheme, very simple scheme called composition scheme, where they said, Aarti madam, that if your turnover is less than 1.5 crores, then you can opt for composition scheme, where if you are a trader or if you are a manufacturer, no need to read GST. See, if you want to become an accountant, no need to read CA course. Correct? Very simple. Only debit credit you should know. Right? But if you want to become a chartered accountant, then you should not be under composition scheme. So if you don't want to read GST, turnover will be less than 1.5 crores, no input tax credit, no HSN code, no 12%, 18%, 5% input, this, that, all those things are not there. Straight away, whatever is your turnover, multiplied by 1%, pay tax. If you're a restaurant owner, pay tax at the rate of 5%. All right. But it comes with a lot of conditions. Now, what are those conditions? Condition number 1, you cannot make interstate outward supply. Condition number 2, you cannot claim input tax credit. Condition number 3, transaction under reverse charge mechanism, you still have to pay the tax and still you will not get input tax credit. Condition number 4, you cannot be dealing in pita. You cannot sell pita. How can you sell pita? What is pita? Pan masala, ice cream, tobacco. Then A is aerated water. So anything after dinner, pan, ice cream, tobacco, aerated water. Okay, anything after dinner or pita, whichever way you want to remember. Okay, please remember, you cannot be dealing in all these products. If you are manufacturer of these products, you are out of composition scheme. Clear? Okay. Now one guy said, sir, I have goods turnover only, little bit services, only little bit services. Okay, so can I be under composition scheme? No, you cannot be under composition scheme. Then they bought in a waiver. They said, if your turnover of last year multiplied by 10% or rupees 5 lakh, whichever is higher, is the amount of service you have rendered, you are still eligible for composition scheme. So what is the exemption? You can have some amount of services. What is that some amount? 5 lakh or 10% of last year's turnover, whichever is higher. See, income tax will always say whichever is lesser. House rent allowance, section 10(13)(a), whichever is less. GST will say whichever is higher. Correct? No, right? So whichever is higher, 5 lakh rupees by default you will get, or 10% of last year turnover. If your last year turnover was 1 crore, you will get 10 lakh limit. To that extent, you can render services. Is this clear? Right? Okay. And interest will not be included for the purpose of computation of aggregate turnover. Interest will not be included for the purpose of computation of 1.5 crores. Is this clear? So interest will not be computed for 5 lakhs or 10% of the turnover will be my service turnover. For that also interest will not be considered. So interest can be excluded for all the turnover related discussions. Is this clear? Now, service provider said, I have only services. Can I opt for composition scheme? They said, yes, we will bring in a new scheme. If your turnover is up to 50 lakh rupees and you cannot opt for composition scheme of 1.5 crores, then we will have a special scheme for you. We will ask you to pay tax at the rate of 6% of your turnover and you can opt for composition scheme. So if it is manufacturer, trader, restaurant owner, 1.5 crores. If you are a service provider, 50 lakhs. Rate of tax, manufacturer, trader, 1%. Restaurant owner, 6%. 5%. If you are a service provider, the rate of tax is 6%. All the conditions applicable to the regular composition scheme is mutandis applicable to this 50 lakhs, except that 5 lakh or 10%, not relevant only, no. Full turnover only service turnover. Correct? So that is section 10. Now let's go. Okay, when can I enter into composition scheme? Only at the beginning of the year. When can I exit from the composition scheme? Whenever I want. Make one outward GST turnover outside the state. Sell something to some goods outside Karnataka. Over, you are not eligible for composition scheme, you can go out. It is like CA course. Entry whenever they issue application form. Exit whenever you want. Correct? No. So entry only at the beginning of the year. Exit whenever you want. You cross the threshold limit of services beyond 10%. Over. You sell tobacco. 1 cigarette packet you sell. You are out of composition scheme. That's all. Clear? So that is section 10. Now we move to section 11. Section 11 talks about exemption from GST. I will not be able to cover exemption chapter, but please read education services. Please make a note of this now. education services, lot of questions on this. Okay, hospital services, government services, agriculture services. These four you please read multiple times. Others also you have to read only. Full chapter you have to read. These four special focus. Is this clear? Tomorrow when we are doing RTP, if any exemptions come up, definitely I will take it up. You have to see whenever you have free time. First of all, you will not have free time, correct? Okay. First starting only I told when we started the classes, when you have free time, please read. That time only you did not have. Now what you will have? But whenever you are taking break, just to run through the exemption chapter. That's all is my request. Okay, because you cannot remember, but you have to keep reading. Clear? Okay. So section 11 is exemption. Now we go to section 12. Section 12 and 13 is time of supply of goods and services. 12 is time of supply of goods, 13 is time of supply of services. Okay, what does section 12 say? Section 12 says you are required to pay GST on sale of goods in following situation on following dates. If the supply of goods involve movement, then the GST has to be paid on the date of raising the invoice or the date you remove the goods, whichever is earlier. Clear? If the goods do not involve movement, then the date of raising invoice or the date when the goods were made available to the customer. Clear? If it is continuous supply of goods, that means the contract requires you to keep supplying the goods. Then the date when you issue the statement to your customer saying that you are required to pay this much amount of money, or if the agreement says you have to pay after 15 days, you have to pay after 30 days. So if an agreement says something based on that agreement, or if you give a statement saying that this month you have consumed this much amount of LPG, this month you have consumed this much amount of cement, so based on that you are required to make this much amount of payment, that becomes the time of supply. Okay, you have two vouchers, general voucher, specific voucher. General voucher can be used to redeem any goods. Specific voucher can be used to redeem specific goods. In case of general voucher, the time of supply is the date when the voucher is redeemed, when you actually use the voucher. Specific voucher, the time of supply is when the voucher is actually issued. Is this clear? So this is as far as time of supply of goods is concerned. RCM not applicable, so we are not discussing RCM. Okay. On advances received for goods, I am not required to pay tax. There is an exemption available. Clear? Now we go to services. In case of services, the time of supply is the date of raising the invoice or date of receipt of money, whichever is earlier, provided I have raised the invoice within 30 days of completion of service. If I don't raise the invoice within 30 days of completion of service, then the time of supply is the date of completion of service or the date of receipt of money, whichever is earlier. Let's take an example. I finished a statutory audit for one of my client on 30th September 2022. Okay. I raised the invoice on 10th October 2022. Okay. Have I raised the invoice within 30 days? Yes. So time of supply is the date of raising invoice or receipt of money, whichever is earlier. I have not received the money. The time of supply will be the date of raising invoice, which is 10th of October. Assuming I finished the work on 30th of September, but raised the invoice on 1st November 2022. Have I raised the invoice within 30 days? No, I have not. So what will be the time of supply? The date of completion of service, which is 30th September, or the date of receipt of money, whichever is earlier. Is this clear? Okay. Voucher, again, same issue. Okay. Specific voucher, general voucher. Then continuous supply of services. Same concept. If I have an agreement and that agreement requires payment to be made based on certain events being completed, then that event is the time of supply. Otherwise, whenever I issue a statement to my customer, that will be the time of supply. Clear? Now, very important thing as far as services is concerned is even on advances, when I receive advance for a service, I am required to pay the taxes, and that is not true as far as goods are concerned. Okay. and services RCM is applicable to us. So in case of RCM, I am required to pay tax under reverse charge mechanism on the day when I have made the payment, or 60 days from the date on which a statement is issued to me by my customer, by my vendor, that I am required to make this much amount of payment. Okay. And when it is related party transaction, which is relating to import, the moment I record the transaction in my books, I am required to pay tax under reverse charge mechanism. So import of service, the day when I make the payment, or 61st day from the date on which a statement is issued to me by my supplier, and in case of related parties, the date on which payment is accounted in my books of accounts, irrespective whether I've made the payment or not. Okay, so that is as far as section 12 is concerned. Sorry, 13 is concerned. 14, enjoy, not applicable. Okay, change in rate of tax, so not applicable to us, right? Okay, section 15. Section 15 talks about what we discussed in section 9. Section 15 talks about value of supply. Okay, what is the value of supply? We have understood value of time now. When we are writing exam and we don't know, we are not able to allocate 10 days per subject. Correct? We thought we will have 10 days per subject plus revision also we'll have time, plus another revision we will have time. And now we don't have 2 days also. And whatever time we allot for one subject, we require 3 more days extra to complete that subject, though we are reading 14 hours, 15 hours. So we have got value of time. Now let's understand value of supply also. That's given under section 15. Okay. So section 15 says, if the transaction is between independent persons. Okay. So we have here Pratibha and we have Pratiksha. Okay, except for the first name, first 3 alphabets, nothing is common between them. They are unrelated parties. Okay, first 6. Apart from first 6 alphabets between Pratibha and Pratiksha, nothing else is common. Okay, so they are independent parties. Okay, when Pratiksha sells goods to Pratibha or Pratibha sells goods to Pratiksha, whatever is the price at which they sold the goods to each other, that is the price on which GST is required to be charged. Let's take an example. Pratibha has a gym which she runs. Okay, Pratibha runs a gym. So now Pratiksha takes a membership of that for 1 year. Okay, which is 20,000 rupees, assuming. Okay, GST is required to be paid on that 20,000 rupees only. Okay, now Shreyas goes to the same gym, Pratibha's gym, and negotiates and says, look at my body, I'm a regular person. If I come, 10 people more will come. Okay, so now Pratibha gives a discount of 2,000 rupees to Shreyas and charges 18,000 rupees. And when it is charged? After 15 minutes of getting money from Pratiksha. Okay, and both Pratibha and Shreyas are not related to each other. Okay, then GST in the second transaction is applicable on 18,000 rupees only. Okay, now Skanda goes to the to Pratibha's gym. Now Pratibha says, if Skanda comes, then whoever is coming will also go. Okay, so she says 25,000 rupees to you. Okay, so now Deepa, finish drinking water, otherwise you'll spit on us. Okay, so now because they are not related to each other, GST is required to be charged on 25,000 rupees because they are not related to each other. Is this clear? But now assuming Pratibha and Ananya are related to each other, and because they're related to each other, Pratibha charges 10,000 rupees to Ananya. Okay, that value cannot be accepted because they are both related, that their relationship has influenced the price. Okay, so at what price Pratibha would have charged to a third party? That is the price on which she has to pay GST. But that price we will find out in CA final, because rules of valuation are not applicable to you. Rule 27, 28, 29, 30, whatever rule I say, how does it make a difference? Not applicable to you, right? So valuation section 15 is applicable. Rules are not applicable. Valuation principle says whatever is the transaction value, okay, on that only GST is required to be discharged, provided parties are not related and price is the sole consideration. Now you've seen our friend Ramya, full stylish, and picnic also full stylish. Is correct? No, Ramya. Okay, only one Ramya is there. Okay, so now Ramya goes to Pratibha and says, boss, if I come to your gym, no, every day one Instagram reel I will post, and looking at that people will come. So now Pratibha says, okay, I will give it to you, give you the subscription at 5,000 rupees. Right? They are not related to each other, but still, because Ramya is able to give something more to Pratibha, Pratibha's prices have got influenced. That price cannot be accepted. Price has to be a sole consideration. That means Pratibha should get only the money. She should not get any indirect benefit. Only then that price can be accepted. Otherwise, price cannot be accepted. Is this clear to everyone? So any direct or indirect consideration, sorry, if any indirect consideration is there, then transaction value cannot be accepted. Right? Okay. That is section 15 subsection 1. That means there is 15 subsection 2 also. Okay, and there is 3, and there is 4, and then there is 5. So section 15.2 says, to whatever I told you as transaction value, no, now add a lot of things. 15.1 is what? Transaction value if parties are not related and price is a sole consideration. Okay, to this you add 15 subsection 2. What do you have to add? You have to add any subsidy given by any person other than central or state government. So now assuming Pawan has a store for selling mobile phones and he is selling these phones on Flipkart at 1,50,000. Flipkart says, I will pay 50,000 to you. You sell one phone at 1 lakh rupees. Now for selling the phone from end customer, Pawan has got only 1 lakh. But Flipkart he has got 50,000 rupees. That subsidy, which is not from the central government or state government, okay, he will have to add to the value of the product for the purpose of discharging GST liability. Okay, our friend Sagar was selling masks during COVID, and now outside metro, because only in metro masks are required, otherwise nowhere in Bangalore mask is required. So now he has monopoly business. Okay, outside metro he will sell mask, because if any customer comes, whatever price he says, they have to buy. Correct? Now there is an NGO which says you're doing a very good job. Whatever prices you sell mask at, I will give you 5 rupees extra. So instead of selling it at 10 rupees, you sell it 5 rupees. Correct? So that NGO is not central government. So now when Sagar sells these masks at 5 rupees and gets 5 rupees from the NGO, he is required to discharge tax on 10 rupees. Okay. Now our friend Chandan is manufacturing electric car. Okay, government says on this electric car, when you sell, I will give you 2 lakh rupees subsidy. So if the car is valued at 10 lakh rupees, he will collect 8 lakhs from the customer and 2 lakh from the government as subsidy. GST is required to be paid only on 8 lakh because 2 lakh this time is a subsidy from the central government or the state government. Is this clear to everyone? Okay. Second, now Chandan sell goods to Skanda and he says you have to pay me within 30 days. If you don't pay me within 30 days, I will charge interest. Okay. Now, section 15 subsection 2 says, if Chandan collects interest from Skanda for delay in payment of consideration, that delay in consideration interest or penalty will also be liable to GST. But now section 12 and 13 says, on the date of sale, when you move the goods, you don't know how much interest you will get or whether you will get or not. So whenever you collect the money from Skanda, that day you pay the tax. So 15.2 says pay tax on interest or delayed payment charges. But section 12 and 13 relaxes and says don't pay on the date of sale. You don't even know what is the interest you are going to receive. You pay it whenever you receive it. Correct? Third, if there are any taxes collected from the customer, say along with sale of renting of apartment, I collect stamp duty, I collect property tax, that will also be liable to GST. If I sell the car, along with car, I collect road tax, that will also be liable to GST. So any taxes collected from the customer will also be liable to GST. But in income tax, correct me if I'm wrong, if a transaction is more than 50 lakh rupees, then TDS will apply. If the car is more than 5 lakh or 10 lakh rupees, TCS will apply. Is TCS a tax? It is not a tax. It is only collection of tax at source. Correct? So when the vendor collects TCS, GST is not required to be collected on the same. Is this clear? Right? Fourth. Okay. Now Tejaswini madam wants to get one house constructed. Okay. She gives the contract to Rahul. Same example which I gave last time also. Okay. Now Rahul was supposed to incur expenses for steel, cement, everything. Okay. And the contract was for 1 crore. Now Tejaswini said, no, contract is for 1 crore. I will give you cement. Now Rahul is charging only 60 lakh rupees. Okay. The contract was for full including cement and Rahul was supposed to charge 1 crore. But now because Tejaswini said, I will give you cement, he is charging only 60 lakhs. Section 15 subsection 2 says expenses to be incurred by the supplier which has been borne by the recipient, that has to be added. So 40 lakhs worth of cement what Tejaswini has incurred has to be added and Rahul has to charge tax on it. But if Tejaswini would have said, you construct my house excluding cement, then the contract was always for 60 lakhs. Then section 15 subsection 2 does not come into picture because it was not the obligation of Rahul which has been met by Tejaswini. Is this clear? Okay, so that is 15 subsection 2. 15 subsection 3 says, what can you reduce from the transaction value? Discount. Discount can be of two kinds. Okay, one which we get, one which you don't get. No. One which is on the bill, one which is off the bill. So if the bill says mobile phone 1 lakh, less discount 10,000, net price 90,000, that is on the bill discount. That can be reduced and tax has to be paid only on the final price, which is 90,000 rupees. Okay. Second is off the bill discount. Now, what is this off the bill discount? Off the bill discount means quantity or volume discount. You purchase 10,000 units, I will give you 1% additional discount. You purchase 20,000 units, I will give you 2% discount. Okay. So based on the volume picked, a discount will be given. Okay. That we will get to know only after the quarter ending, only after the half year ending, only after the year ending. Okay. So there 15 subsection 3 says you are allowed to issue a credit note to reduce the value of the transaction only if there was a written agreement between you and your customer that you will give this discount. That is point 1. Point 2, this discount should be passed on by way of a credit note. So section 34 will come into picture. Section 34 says credit note has to be issued within 6 months from the end of the financial year. Okay. And third, the other person should reverse the credit. Only if these 3 conditions are satisfied. What? Pre-agreement, credit note, and reversal of credit. Only if these 3 conditions are satisfied, then the supplier can claim deduction of value of tax to the extent of credit note. Is this clear? That is what 15 subsection 3 says. Now we go to section 16. Can we take a 1 minute break? 1 minute, not more than that. I just fix
Yes,
some
sir.
water. 1 minute. Now we go to section 16. Guys, quickly come back. Section 16. Section 16 talks about input tax credit. Okay. Now, what is this input tax credit? It is a cashback which we discussed. Correct now? Right. Okay. Now, who can claim? Any registered person. That means you should be registered under the GST law. Only then you can claim the benefit. Otherwise, you cannot claim the benefit. Okay. And of what? Of the taxes charged on you. All right. And it should be used in the course of furtherance of business. Only if you satisfy these conditions, the credit will be available. There are multiple other conditions, but as of now, the principal condition is you should be registered. The taxes have to be charged to you, and you should be using it in the course of furtherance of business. Okay. Section 16 subsection 2 adds a lot of other conditions. What are those? You should have received the goods or services. If you are receiving the goods in installment, you have to wait till the last installment is received. If it's a bill to ship to transaction where the bill is coming to you, goods are getting shipped directly to your another customer, then the day when he receives the goods, you are entitled to take the credit. Okay, so first is you should have received the goods or services. Second, you should be in receipt of the tax invoice or bill of entry, or you should have raised the invoice on yourself. Only then you can take the credit. So there has to be a document based on which you can take the credit. Correct? Third, you have to ensure that you make the payment within 180 days. If you don't make the payment within 180 days, reverse the credit and re-avail it whenever you make the payment. Correct? That is condition number 3. Condition number 4, he should have paid the tax. The supplier should have paid the tax. And condition number 5, I should have filed my returns by claiming this credit. Only if these 5 important conditions are satisfied, I am entitled to take the credit. Then section 16 subsection 3 says, if it is capital goods, you should not capitalize the GST portion. You should not have claimed a depreciation benefit on the GST component. Okay. Then section 16 subsection 4 says, the last date for availing the credit is 6 months from the end of the financial year, or the date of filing the annual return, whichever is earlier. Clear? Here it is earlier, it is not later, because it's a benefit they are giving. Okay, so only if all these conditions are satisfied, you are entitled to take the credit. Now, few exceptions here. When I am supplying goods to my related party, schedule 1 says, even if there is no consideration, you have to pay tax. I will pay, but how will I make the payment within 180 days? Because I have agreed to sell goods free of cost to my customer. I will pay the tax, but if it is free, why will he pay me money? Then to all my relatives, I'll keep sending goods. If my sale is less, no, I will send it to my relatives, some goods, and say, hey, you have to pay me, no, GST losses, you have to pay within 180 days. Correct? So now here the GST law says, if there is no consideration, but you are paying GST because it is a deemed supply, then for the purpose of 180 days, payment is not required. Credit can be claimed. Because if there is no consideration, what will they pay? Correct? Second, section 16 subsection 4 says credit has to be claimed within 6 months from the end of the financial year. But if you have not made the payment within 180 days, you are required to reverse the credit. Whenever you make the payment, you can re-avail, even if it is beyond 6 months from the end of the financial year. So let's take an example. I have availed credit of an invoice dated 1st April 2022. I did not make the payment by 27 September 2022, which is 180 days. Okay. I have made the payment on 31st October 2022. I will avail on 1st April, reverse on 27th September, re-avail on 1st December 2022. Correct? Now, same invoice, I have made the payment on 31st December 2023. I will avail the credit, reverse the credit. The last date to claim the credit was 30th September 2023. I have crossed that also. Still, I will be able to claim the credit in December 2023 because that 180 days criteria does not apply to re-availment of credit for which payment was not made within 180 days. Is this clear? Okay. Now we go to section 17. What does section 17 say? Section 17 says where you cannot take the credit. 16 was where you can take the credit. Section 17 is where you cannot take the credit. Now, what are the cases where you cannot take the credit? If you are not using something for the purpose of your business, if you are not using for the purpose of taxable supplies other than exports or zero-rated supplies. Correct? Zero-rated supplies to SEZ. Okay, unless you are not using it for taxable supplies, you cannot take the credit. So if you are manufacturing exempt product, you will not get the credit. If you are a hospital who is treating cancer, you will not get credit. If you are a hospital who is treating Anushka Sharma, who is treating Rakhi Sawant, who is treating Jennifer Lopez, you will get the credit. Correct, no, Pawan? Pawan has done full PhD in what all, who has done? Right. Okay. So if it is cosmetic surgery, this taxable, you will get the credit. If it is regular healthcare related services, it's exempt, you will not get the credit. Okay. Section 17, subsection 5 is the most important section because a lot of questions are asked around section 17, subsection 5. What is section 17, subsection 5? Blocked credit. You cannot take the credit even if you have satisfied all the conditions. Okay. What are those? up to 13-seater capacity motor vehicle, you cannot take the credit. Deepa, you might have Maruti Omni where 15 people are sitting. We are talking about capacity, not capability. Correct? So no credit. But if you have a tempo traveler, you can take the credit. Is this clear? Which has more than 13-seater capacity. But if you are using that car for the purpose of transportation of passengers, right, where you're collecting money from the customer, right, you can take the credit because you're using it for a taxable purpose. Okay, or where you're using that car for ensuring that somebody else learns the car, okay, you can take the credit, right? So there are 3 situations where you can take the credit on car. One, when you are teaching somebody to learn. Second, when you're transporting the passengers. Or third, when you're reselling it. Mandavi Motors, they'll buy and sell, they will get the credit. Okay, Anand Sweets will not get the credit. But if it is not passenger transport service, if it is not passenger vehicle, but it is goods vehicle, there you can have a 13-seater capacity. There will be only 1 person or 2 persons. That's all. Everything else for luggage only. There you can take full credit. So the restriction is applicable only to passenger vehicles, not to goods vehicle. Goods vehicle, even if 1 person can sit or 1 person not sitting, half the time is standing only because luggage is there below his seat also. There you can take full credit. Is this clear? Same restriction for aircraft and vessel. Vessel is what? Not patre. It is ship, right? So on vessel also same restriction. If it is for passenger, no credit. If it is for goods, you can take the credit. Is this clear? Now, once a car or a vessel or an aircraft is ineligible, no, insurance also you will not get, maintenance also you will not get, and you will say, oh, I will not buy the car because I will not get the credit. I will take it on rent for 10 years and use it. On renting, hiring, leasing, that also you will not get. What you cannot do legally, I will not allow you doing it illegally also. So buying the car, maintenance of the car, repair of the car, insurance of the car, renting, hiring, leasing of the car, nothing you will get the credit. Correct? But if that car is eligible because it is more than 13-seater, or because you're using it for some specific purposes, or because it is goods transport, then all of this you will get the credit. Clear? That is as far as car is concerned. Now, employee related. If you are spending money for personal travel of the employee, not business travel, okay, then you will not get the credit. So director and secretary goes, that is business travel. Okay, but employee and wife goes, that is personal travel. Understand the difference? Okay, if secretary goes business, wife goes personal. Personal you will not get credit. So that means government is saying go with secretary only. Otherwise you will not get credit. Okay, so that is second point. So employee related, food, beverages, outdoor catering, cosmetic surgery for employees. If you do, you know which industry will do other than aircraft, but if you do, no credit. Okay, employee insurance or health insurance, health and club fitness, gym, Bangalore club, all that, no credit. Clear? But asset insurance you will get. See what is restricted? Employee insurance and health insurance. That means government is only saying employees are not your assets. Only laptop and building are your assets. On that only you will get credit. Correct? So on laptop you will get, on building you will get, on stock you will get. Employee you will not. Clear? Then third, if you buy something from a composition dealer, you cannot take credit. He cannot charge tax only. But still they are saying, see, you were supposed to read in the original class only. Why we had revision class? Correct? No, like that they are not supposed to charge. But even if they charge, you don't take the credit. Revision, right? Okay. So this is third. Fourth, if you are buying goods or services for the purpose of construction of an immobile property, which you are not going to sell, but you are going to rent it out, okay, you cannot claim the credit. I will repeat again. Construction of building or purchase of goods and services for construction of building, which you are not going to sell, okay, which you are only going to rent it out, you cannot take the credit. Example, Shobha Builders constructs a building for sale, they can take the credit. Prestige Builds Forum for renting, no credit. Taj constructs hotel for renting, no credit. PVR constructs building for theater, no credit. You are able to follow? Right? So construction for other than sale, you will not get the credit. Okay. Then 17(5)(h), very important. Goods lost, stolen, destroyed, or disposed of by way of gift or sample. So if you are letting go away of goods on which you had claimed credit, you have not done anything out of it, I will not allow you to claim the credit. Is this clear? Okay. So that is 17 subsection 5. Now we go to section 18. What is section 18? Section 18 talks about special situations where earlier you were not entitled to take the credit, I will give you credit. Where you were entitled to take the credit, I will take off that. 18. Okay. So section 18 says, if you have stock of goods lying with you and you are liable to obtain registration, so that means you are required to pay tax on these goods available with you. Originally you would not have taken the credit because section 16 says registered person can only take the credit. Now I will create an exception, you can take the credit. Okay. So if I have stock with me and I'm liable to register, government says I will give you credit on the stock. If I'm not liable to register, but I voluntarily registered, the day when the registration is given, on that day, whatever stock I have, I will get credit on it. So the difference between the two is, when I'm liable to register, the credit will be on the stock available with me when I'm liable to register. In case of voluntary registration, I will get the credit to the extent of stock available with me when the registration is granted. Clear? Third, when I move from composition scheme to regular scheme, whatever stock is available with me, on that I will get the credit, because now I'll start paying full rate of tax. Okay. Fourth, when my products are exempt but suddenly becomes taxable, then whatever is the stock available with me, on that also I will get the credit. So in all the four situations, whatever is the stock available with me, I will get input credit of that. But whatever input services are there, I will not get the credit, because you cannot say I have paid 1 month rent, 15 days is still in stock. Correct. Or I've taken Katrina Cafe for advertisement. So Katrina Cafe, still 20% value is there. You cannot say that. Service is consumed the first day, right? So you will not be entitled to take the credit on input services. But capital goods, when you move from composition to regular or from exempt to taxable, then to the extent you were in the period of composition scheme or exempt scheme, 5% depreciation you will have to let go per quarter. Whatever is the balance useful life of the asset, on that you can claim the credit. That means if you are under composition scheme for 2 years, 40% you will not get the credit, 60% you will get. If you are under exemption scheme for 4 years, okay, asset you purchased 4 years back and you are under exemption scheme, 80% you cannot take credit, only on the balance 20% you will be entitled to claim the credit. Is this clear? But when you are liable to register or voluntary registration, you will not get credit on the capital goods. Clear, everyone? Okay. Now we go to cases where I have to pay back the tax. Okay. If I am under the regular scheme and move to composition scheme, whatever stock is available, I will have to pay back that tax on the stock. Okay. If I'm on a taxable scheme and I move to exempt scheme, whatever tax I had on the stock, I will have to give back. Input services, nobody will question. But capital goods, again, 5% depreciation will be calculated. Whatever is the balance useful life, on that I am required to pay back the tax. Now, one interesting situation. Assuming the tax to be reversed by me, input tax credit to be reversed by me is 1 lakh. My input credit register also is 1 lakh. Then I will utilize the input tax register to pay the tax. Okay. But if my input tax register is 80,000, then 1 lakh I will reverse to the extent of 80,000 and 20,000 I have to pay cash. But if my reversal comes to 1,40,000, okay, my credit balance is 1,40,000 and I have to reverse only 1 lakh. 1 lakh I will reverse and 40,000 swaha. It will lapse. Is this clear? Last provision in section 18, last two actually, two provisions, I'm sorry. Two provisions in section 18. Chaitanya madam, not last topic today. Last two topics in 18. Okay. Two topics in 18. If I am selling an asset on which ITC has been claimed, then the GST has to be paid on the transaction value as per section 15 or the useful life of the asset by calculating 5% depreciation, whichever is high. So let's take an example. Okay. I purchased a laptop at 1 lakh rupees. Okay. I am selling it after 1 year. So what is the depreciation as per GST? 20%. So what is the value of the laptop now? 80,000. I was able to sell that laptop at 60,000. But for the purpose of GST, I will pay tax on how much? 60 or 80? Whichever is higher. 60 is the transaction value or the useful life of the asset considering 5% depreciation. Whichever is higher. 80,000 is higher. I have to pay tax on 80,000 rupees. Is this clear? Right? Next, important provision of section 18 is when there is merger, demerger, when the business transfers from a deceased person to the legal heir, then whatever is the closing stock of the input tax credit that can be transferred to the legal heir, that can be transferred to the resultant company, or it can be transferred to the consolidated company. Okay, so whenever there is input tax rate, that can be transferred. Now in case of demerger, the important issue which comes up is A became B and C. To whom the credit has to be transferred? Depending on how much assets have been transferred to B and how much assets has been transferred to C, in that percentage, the input available has to be bifurcated between B and C. Is this clear? Right? Okay. This as far as 18 is concerned. Okay. 19 is input service distributor, not relevant. 20 and 21 is job work, not relevant. So we are skipping that for the time being. Okay. Now we go to 22, 23, 24. And guys, my friends, there have been a lot of amendments in registration chapter, which are procedural. Please do Aadhaar authentication, otherwise refund will not be granted. Revocation of cancellation of registration cannot be filed. You cannot apply for refund for payment of tax on export supplies. All that, even if I tell you, there is no point, because there's nothing to explain in that. That is what it is. Will the condition change if I explain? But you have to read it. There are a lot of amendments in procedural aspects of registration. Please go through your study material thoroughly, the updated one. Okay. Right. Now, one more thing in the supplementary material I saw, which has been issued. If you see the heading, no, the Finance Act has been passed, but the following provisions have not been notified. Wherever you read that, no, whatever is below, no, just scratch it. It is not relevant because it is not notified. Is this clear? So tomorrow what we will do is we will go through the supplementary material and try to help you scratch whatever is not relevant to you. Okay, so that you don't have to read. First of all, so much of time is there. Correct. In that, if you waste something which you are not required to read, what's the point? Correct? Okay. So now let's go to section 22, 23, 24. Section 22 says, if your turnover is not exceeding 20 lakhs, you are not liable to register. Okay. Only if your turnover exceeds 20 lakhs, you are liable to register. Now, some of the states said 20 lakhs is very less. So if it is transaction in goods, which is intrastate supply, and I'm not supplying PITA, same composition scheme goods, then the limit has been extended to 40 lakhs. So if you look at the material which I've shared, I've given you the state names also. And unfortunately, you have to remember those state names also. Okay, where the 40 lakhs limit is applicable. So all the states, it will be 20 lakhs. Notified states, the enhanced limit of 40 lakhs will be applicable. Okay, and when is it applicable? Only if you are dealing in goods, which is intrastate supply, not dealing in PITA. Only then the enhanced limit of 40 lakhs is applicable. So section 22 says up to 20 lakhs, no registration. If the state has given a notification for 40 lakhs, then the enhanced limit of 40 lakhs will apply. Okay. Section 23 says, irrespective of the turnover, if your turnover is only exempt supply, or if your turnover is only liable to tax under reverse charge mechanism, you are not required to obtain registration under the GST law. Okay, so I am a cancer hospital having turnover of 500 crores. Am I liable to register under 22? Yes, because it is more than 20 lakhs. But can I get an exemption under 23? Yes, because 23 says forget 22. Right now, I have 500 crores cancer turnover, cancer treatment turnover, and 1 lakh rupees parking fees. I do not get an exemption under 23 because 23 says you are exclusively engaged in exempt supplies. Now I have made some taxable supply. I'm out of 23, come to 22, obtain registration. I will pay tax only on 1 lakh, but I have to get registered. Okay. Now we go to section 24. Section 24 says cases where forget 22. It does not say forget 23 here. It says forget 22 again. So 23 also says forget 22. 24 also says forget 22. Okay, that means it's like Dinesh Karthik, Papa. They take him in the team, but they don't allow him to play. Okay, so section 24 says forget 22. You are required to obtain registration under the following. If you fall under any of the following situations, irrespective of whether your turnover is 20 lakhs or 40 lakhs or not. Okay, what are those? One, if you are a casual taxable person. Second, you are non-resident taxable person. Both of it we'll discuss after a minute. Okay. Third, if you are OIDAR, not relevant to you, online information database access retrieval services, not relevant. Okay. If you are an agent of a principal covered under Schedule 1, that means when you are an agent and supply the goods or services in your name, not in your principal's name, in that case, Schedule 1 will apply. Once Schedule 1 applies, you cannot take exemption of 20 lakhs. You have to obtain registration under the GST law. Is this clear? Okay. Then, if you are liable to pay tax under reverse charge mechanism, see, if you go to sponsorship services to a body corporate, that means you're liable to tax under reverse charge. Even if your turnover is less than 20 lakhs, you will have to obtain registration because of 24. Okay, but look at another case. It's a which we can say legal services. Legal services liable to tax only if the services are rendered to a business entity. Okay, you're not a business entity at all, right? You don't have to get registered only because you're taking legal services, right? So because of your status, you should be liable to pay tax. Only then under section 24, you're required to obtain registration. Okay, or security services liable to tax only if rendered to a registered person. You are not registered. Now, because of section 24, you don't have to obtain registration because there is no liability to pay only. Liability comes only when you're registered and you're not registered. Clear? Okay. So that is as far as section 24 is concerned. Now let's look at what is NRTP and CTP. CTP means casual taxable person. You are in Bangalore, but you want to go to Delhi for an exhibition and you want to sell the goods in that exhibition. Okay, then you become a CTP in Delhi. That means casually you are going and doing business. Okay, but if you don't have an office in Bangalore at all, okay, or in India, and you want to participate in an exhibition in India, then you are an NRTP. That means you are a non-resident person. Okay, in both the cases, whether CTP or NRTP, you have to obtain the registration in advance before you start the business, and that registration is valid for 90 days. If you are not able to conclude your business within 90 days, it can be extended by another 90 days. And you have to pay the taxes in advance. That means if you're expecting that the sale is going to be 1 crore, 1 crore multiplied by 18%, 18 lakhs you have to deposit. But if you're expecting some input tax rate, reduce to that extent, and the balance amount you have to deposit by cash as advance. Also, one important point, if you're a CTP, you will get input tax rate of everything. But if you're an NRTP, you will get credit only of the taxes paid by way of bill of entry on import of goods into India. So let's look at what are the common points of CTP and NRTP. CTP and NRTP, temporary registration, applicable only for 90 days plus 90 days. Advance to be deposited in cash. Advance tax to be deposited in cash. What is the difference between CTP and NRTP? CTP has a place of business in India, but not in the state where he wants to do business. NRTP does not have a place of business in India at all. CTP can claim input tax credit of everything. NRTP cannot claim the credit of everything. He can claim the credit only of the taxes paid by him when he imported goods into India. Clear? Okay. Now we go to other related aspects of registration. Now, once you have obtained registration, you are expected to file the returns. If you don't file the returns, the officer has got powers to cancel the registration. That is called suo motu cancellation. Means what? Without asking you, they can cancel the registration. But the moment you get a notice that the registration is going to get cancelled suo motu, if you file the returns within 30 days, then the suo motu cancellation will get cancelled. That means your registration will be restored. Is this clear? If officer has a doubt that you are doing all wrong transactions, or if the officer has a doubt that you have not started the business at all, even there he can cancel the registration. But when he cancels the registration, he has to issue the notice to you. You will have to present your case, and only when he is not convinced about what you are saying, he can cancel the registration. Otherwise, he has to restore your registration. Is this clear? Now, if you have stopped doing the business, then you can also voluntarily apply for cancellation of registration. So how can you cancel the registration? Either voluntary you can apply, or the officer can decide that you should not be given the registration. Is this clear? Now, when you don't file the returns, and that happens in COVID a lot of times because people did not have money to pay the taxes. Okay, they are doing business, but they don't have money to pay the taxes. Okay, then the officer will suspend your registration. Okay, you file the returns, pay the tax, the suspension will get revoked. But if you are not able to pay the taxes by then also, then that suspension will become cancellation, actual cancellation. In that case, you can apply for revocation of cancellation within 30 days. Okay, to the same officer who has cancelled your registration. But if you don't apply within 30 days, next 30 days you have to go to his boss, that is assistant commissioner, sorry, additional commissioner or joint commissioner. If within the 30 days also you don't, then go to commissioner. If in that next 30 days also you cannot do anything, then nothing can be done. Right? So first 30 days, same officer. Next 30 days, additional commissioner. Next 30 days, commissioner. You have to keep going to get the registration cancellation revoked. That is cancellation of cancellation. But after 90 days, if you have not taken any action, it is permanent that you cannot get the registration back. You can apply for a new one. Officer will decide whether he wants to give you or not. Okay. Next, if you have one registration in Karnataka and you have a place of business in another state, compulsorily you have to take 2 registrations because GST is state-wise registration. Okay, PAN number will be same, PAN is same, but registrations are 2. In the same state, if you have 2 locations, you have an option to take 2 registrations. See, if you have 2 locations in 2 states, it is mandatory to take 2 separate registrations. But in the same state, if you have 2, 5, 10 places, if you want, you can take a separate registration. If you don't want, you don't have to take a separate registration. But if you have a SEZ and a non-SEZ unit, okay, then compulsory in the same state, compulsory you have to take 2 registrations. Is this clear? Okay, so that is as far as registration is concerned. Now we go to section 34 straight away. 31 is documentation and all. Please read. What are the constituents of invoice? What should be there in the delivery challan? All that fields I will not be able to tell you. Whether you should have a 4-digit HSN or 6-digit HSN. All please read on your own. Okay. Section 34. What does section 34 says? When can you issue a debit note? When can you issue a credit note? Okay. Section 34 says debit note can be issued when you want to increase the value of the invoice. Okay. Credit note can be issued when you want to reduce the value of the invoice. Now, when do you want to increase the value of the invoice? Because the rate what you charged was less, or the rate of tax what you charged was less. Then raise a debit note. Okay. When the rate what you charged was high, or the rate of tax what you charged was high, or there is a sales returns, you will issue a credit note. Debit note means additional liability, no time limit. Credit note is reduction in liability to be issued by 30th September of next year. Otherwise, you will not get the benefit of credit note. Clear? Benefits always have conditions. Liabilities will never have condition. Is this clear? Okay. Now we go to some unique concepts which have been introduced under the GST law. E-invoicing. So one is you have to raise invoice. Second is if your turnover is more than 20 crores in any of the last years from 2017-18 onwards. Okay, when we were discussing in the class, I had mentioned 50 crores, but for your exam now it is 20 crores. Okay, so if any of the years starting from 17-18, if your turnover exceeds 20 crores, then you have to obtain. In the next batch it is 10 crores, so it is very dynamic. Okay, for you it is 20 crores, right? So if your turnover exceeds 20 crores, then you have to generate invoices electronically. Now, what do you mean by generating invoice electronically? That means you will have to upload all the data on a new website called IRP, Invoice Reference Portal. The moment you upload all the data on the Invoice Reference Portal, it will give you a 64-digit number, which is IRN, Invoice Reference Number, and it will give you a QR code. Both the invoice reference number and the QR code has to be mentioned on the invoice. Is this clear? And this is applicable to invoices, debit notes, credit notes, wherever you charge tax. It is not applicable on exempt products because you are not charging tax. It is applicable on exports because you are supposed to charge tax. You have not charged, but you are supposed to charge tax. Is this clear? But requirement of generating invoice reference number is not applicable for government and government entities. SEZ units, SEZ developer has to generate, SEZ units are not required to generate. Then goods transport agencies, passenger transport agencies, and multiplexes. These 5 guys are not required to generate invoice reference number, even if their turnover crosses 20 crores. Is this clear? Invoice reference, IRN can be cancelled within 24 hours. If you don't cancel, it becomes a permanent document. Now, what does the invoice reference number do? As soon as you upload the invoice on the invoice reference portal, it will update your GSTR1. That means your return for outward supplies is finalized. It will update your part A of e-way bill. We will discuss what is part A and part B of e-way bill. Okay, so that means your e-way bill also done automatically, right? So that is the importance of, or that is the relevance of e-invoicing. Next we have e-way bill. What is e-way bill? If you are moving any goods more than 50,000 rupees through a motorized vehicle, then you will have to update all the details on a portal for generation of e-way bill. E-way bill has 2 parts, part A and part B. Part A, you will mention all the details available on the invoice or the delivery challan, where you're sending it to, from where you're sending it to, what is the GST number, what is the value, what is the tax, date of the document, invoice of the invoice invoice number, all of that you will mention in part A. Transporter's name and number, you will mention GST number, you will mention in part B. If you don't generate part B, then GST or e-way bill is incomplete. It is invalid. Is this clear? If you don't have an e-way bill, the vehicle can be caught. The goods, on the goods, the penalty can be levied equal to the tax amount, 2 times the tax amount. So if you had to pay 18% tax, the penalty will be 36%. Okay. Now tomorrow we'll solve a problem also on validity of e-way bill. What is the validity of e-way bill? When it up to when it is valid? What if the vehicle gets damaged? All those things we'll discuss it tomorrow. Okay. Then we have if the officer believes, okay, that the credit which you have claimed is fraudulent, then he can block your credit under Rule 86A. That is called blocking of fraudulent credit. So your credit was 10 lakh. It will block the credit of 2 lakh, so you will not be able to utilize that credit. So that is the power available to the officer if he believes that the credit claimed by you is fraudulent. Then 86B is a new provision. Okay, all these are for fraudulent transactions to reduce the number of fraudulent transactions. 86B says if you are paying taxes, okay, 99% of the taxes only can be paid by credit. At least 1% tax has to be paid by cash. At least 1%. And I saw a couple of problems are on this 86B. At the end they will write, please compute the tax payable taking into account rule 86B and ignoring all the exceptions. There are exceptions to it. So if as a company, I have paid 2 lakh rupees as tax in the last 2 years in income tax, okay, or any of my directors have paid 1 lakh rupees income tax in the last 2 years, then this 1% rule is not applicable to me. Or if I have claimed refund because I'm exporting goods, then this 1% rule is not applicable. But what does the problem say? Compute the tax payable considering 86B, ignoring the exceptions to 86B. So what you will have to do, if they say 86B, then 99% will be by credit, at least 1% will be by cash. Clear? So we'll see if we get some problem on that. We will try solving that problem as well. Right? Okay. So that is what I had for today. Tomorrow, what we will do is at least try to solve 1 or 2 revision test papers or some last year or last batch exam paper, so that you get a little used to the format of the paper and how the answers have to be presented. Right? Okay. Thank you guys. Thank you very much. I will see you same time tomorrow. Same time, Andre. Starting time is same, not ending time.
Yes, sir.
Thank you. Any doubts?
Thank you.
Okay, right. Thank you.
Thank you.
Okay.